This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. I did a monologue recently on this podcast, just me talking, and I found some excerpt that somebody had written about trend following, and I added it to my commentary. And I quoted the guy's content and I quoted his name, Alex Krainer. I did not know Alex, but I liked what he was saying about trend following. Lo and behold, one of my friends at Dunn Capital, Jenny, who has been on this show, texted me and said, "Hey, you should contact Alex. He'd be a great guest." Well, I did so. Today, Alex Krainer and I talk all that is trend following, how he came to it, a different way than I came to it, but he found his way to it. That's the cool part. And based out of Monaco, a place that I once visited a long time ago, really tiny, but very cool. I'm sure there's many, many levels and layers to Monaco that one could never see on just a quick trip. Without any further delay from me, let's jump right into my conversation with Alex, talking a little trend following and also talking his new book, The Trend Following Bible. I hope you enjoy this conversation with Alex Krainer. I saw something you wrote. I commented on one of my podcasts. The next thing I know, Jenny at Dunn Capital is texting me, introducing us. I'm thinking to myself, I don't know of Alex. He's got a book title out that seems to be in my world. So I said, well, I should probably talk to Alex because I'll trust that if you know Jenny, and Jenny knows good people that I know as well. So I thought, well, this is an interesting offshoot of my world that I have not gone down this rabbit hole yet. So here we are.
There we are.
How long have you known the folks at Dunn Capital?
Oh, not very long. Until about, let's call it 2 years ago, I was in my own silo. I spent 8 years of my life managing a tail event fund at Altana Wealth. That's what I did. And it was only at the beginning of 2020 that I began to open up to the world with what I do. Rather than just sitting, managing my portfolio and keeping it at that. It's been just a few months.
You're one of these people that I've always theorized that while I've done a pretty good job of digging under rocks, so to speak, and finding all kinds of people, some that perhaps never wanted my publicity that I gave them. So you are one of these people I've always kind of known that are out there that have kept themselves unknown.
Yeah, you could say that. And as you put it, I didn't want publicity, but there comes a time because, trend following has gone through a period of about 10 years, which has been about as unfavorable as anything we've ever known. So a lot of the strategies, a lot of the fund ideas didn't work out. And so now you find yourself at the back of 10 years of drought, and either you lose legitimacy or you get out there and start speaking about what you know to the broader public, because I think we're getting back into a period where active asset management and particularly trend following are going to go gangbusters. And I think there's 4 reasons for that. One of them is inflation. The second one is that we are at the peak of a bubble, which I'm not predicting the bubble's imminent bursting. I'm just saying that all bubbles do burst eventually. We don't know when, we don't know at what level, but it will burst. The third reason is the commodity super cycle. There's a lot of things coming together that are going to cause significant price readjustments in security markets, and you can't predict those events.
Well, you can already see in, let's just call it trend following fund manager performance data, you can already see that what you're saying is going to happen, at least has been happening for the last couple of years.
Yeah, and particularly in the last couple of months. And as we're speaking, I just remembered the fourth thing that I wanted to mention is the impending energy crisis that we're going to be facing over the next 10 years or so. So all of these things are going to lead to major price readjustments in the security markets, particularly commodities. And these are things that I'm convinced 100% that the only way to navigate them reliably and profitably is with systematic trend following. About a year ago today, just about a year ago, we saw oil prices crash by 75, 80%. And I don't know one fundamentals analyst in the world, and I started as an oil trader. I follow energy market. I still do read my stuff and I pay attention. There's not one fundamentals analyst who predicted last year's oil price crash. But at the same time, every trend follower worth his salt was short and made money on that event.
Let me keep it at that for one point. Here you are, been an energy trader, oil guy. And I remember back in 2007, I had the good fortune to find my way into Boone Pickens' office. And that was right after he had made several $1 billion. But, he then lost it all, basically. I'm sure he kept $1 billion when he died, but he made a big call and he got a lot of credit. He made a bloody fortune, but then his system wasn't what you're talking about. It was something more. He was a wildcatting guy from Texas, and he had done Texas, Oklahoma, done really well. Wham, bam, thank you, ma'am. And it gets to your point too, where it's like about narrative. You could have all the narratives in the world, but there's one final arbiter, isn't there? And that's the price.
That's the price, correct.
Tell me some background. Where are you from?
I'm originally from Croatia. When I was 17 years old, so that was 1987, I went on a student exchange program to the United States. So I was placed near Los Angeles in a place called Simi Valley. And I stayed there for about 3 years. I finished my high school, went to university. Then I transferred to Switzerland. I got some scholarship and I went to some private American university called American College of Switzerland. And I finished my bachelor's there and I started my master's, but I didn't finish it because I thought it was all kind of a Mickey Mouse.
Waste of time.
Exactly. So then I went to Venezuela because I met a Venezuelan girl. That didn't work out because in 1993, Venezuela had a big banking crisis and the whole country ground to a halt. Meanwhile, there was a war raging in the former Yugoslavia and Croatia had like 35% of its territory occupied. And so I thought, okay, I don't know what to do with myself, so I may as well volunteer, go to the army. And so I did that. I served the army through to the end of the war, which wasn't much longer anymore. Like there was another year. And then in 1996, I came out of the army. I got discharged and I got the opportunity to come work for an oil trading company in Monaco. And I came to Monaco and I started working for this oil trading company, dreaming that I would become an oil trader. I dug in, I started doing everything I knew how to do, reading, analyzing. And very quickly, I realized that everything that I learned in university was useless in terms of, it was good to learn math and English, but the economics, the idea that you're going to analyze markets and predict the price movements, I lost those illusions very, very quickly. And so this was in the late 1990s.
Let me keep you there for a second. You go to work for Oil Trader. I assume a decent concern. You walk in and it is a fundamental shop.
Correct.
That's what you're learning. That's what you're applying.
Yeah.
What was the moment that it broke down in your mind? What was the trigger where you said, this doesn't work? Or I need to find something else, or what are other people doing? What was the moment that snapped you?
There wasn't a precise moment, but there was a confluence of several events. Okay, they're all interesting, so I'll tell you. The first thing is it was the late 1990s, so that was the dot-com boom. The economy was on a tear. Oil prices were in the low 20s, high teens. And as oil analysts, like in the oil industry, there was like a consensus that oil prices had to go higher because the economy was growing. Capital was favoring investments in technology, internet stocks, telecommunications, Cisco's and so forth. And so the investment into oil extraction, exploration, refining was contracting worldwide and the demand was growing. So it was obvious based on the fundamentals that oil prices had nowhere to go but up. I'm talking $18, $19, $20 a barrel. Over the next 2 years, so let's say through 1998, oil prices halved. In spite of everything we knew about it, oil prices halved to $10 a barrel, even a bit lower. And so I thought weren't we wrong about this? And I noticed at the same time that the trend was just down, 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 down. At the same time, the dot-com bubble was on a tear as well. And we kind of paid attention to that as well. But everybody knew that the market was stupidly overvalued and that it had to crash. But then in the last 5 months of the dot-com bubble, the Nasdaq put on another 110%. Imagine being the smart market analyst who shorts the market before it's going to double again. So that was bad. Then there was LTCM that happened in 1998. Robert Merton and Myron Scholes, two big Nobel Prize laureates led by the legend of the legends, John Merriweather. They crashed, right, with their smarts. And then there was this particular story of Victor Niederhofer. I don't know if you remember Victor Niederhofer.
I've written about Victor quite a bit.
Oh, okay, then you know the story. And so, when I started to work as a market analyst, Victor Niederhofer's book, Education of a Speculator, was one of the books that I read. I kind of thought, okay, this is how it's done. This is what I need to learn. And then in October of 1998, I read in the newspaper that he lost his entire fund in one day. And I thought, holy shit, what am I doing? What is this business that I'm getting myself into? But the one thing that stood the test of time was the observation based on the oil market, based on the dot-com boom, based on a million things that I've seen since then, is that markets move in trends. And I'll qualify this statement to make it a bit more precise. The biggest risk in speculation, and conversely, the biggest opportunity for investors and traders, are the large-scale price events. Okay, large-scale price events like when Tesla goes up 120 times in the space of 10 years, when oil price goes up 24 times in the space of 10 years, and I could name 100 examples of this. These large-scale price events never happen overnight, right? Tesla didn't just reprice from one day to the next 10 times or 100 times, right? It happened over a period of 10 years. And so these large-scale price events, which are your greatest opportunity and your biggest risk, always unfold as trends. And there are very few exceptions. I think in 2015, with the Swiss franc, when there was a huge repricing overnight. But those things are like the financial equivalent of having a piano drop on your head as you walk down the street. You can't compute that. You can't take that into account. But ordinary events in life, large-scale price events, always unfold as trends. So that one hypothesis has stood the test of time for the 25 years I've been in the market.
Let me keep you at that point for a second. We're in the late 1990s. You are observing the idea of trend. You see that fundamentals are not working. When did you have the light bulb moment that there were other players out there using this strategy called trend following, and to actually learn who these people were? How did that unfold for you?
Okay, so first, I would put it at about 1999 when I resolved that we have to go into trend following, that we just had to figure out what are these trends and how do we trade them.
Did you know at that time that there was a Bill Dunn?
No, that built on. I didn't have any idea that CTAs existed. I didn't have any idea that there was a trend following Richard Dennis.
Nothing.
I didn't know any of that thing. I just started from a blank page, literally.
Gotcha.
It's just the observation, study, research converged on this idea. And then I learned all these things that you're asking me about from I picked up one of your books, the first one, I think, Trend Following. I also had a friend who effectively ran a CTA fund for himself. I'm not going to mention his name because I'm not sure that he would want publicity, but this was a Swedish gentleman who ran his own portfolio and used basic trend following strategies. And I know for a fact from him, because I've known him for many, many years, and we met and discussed things very regularly, that he had a compound annual returns of around 40%. And he started in the early 1990s. He started with $125,000 and he traded that portfolio for the next 15, 16 years. And in 2009, I remember like it was yesterday, we had lunch together and he says, Alex, my portfolio hit $100 million. That's the power of trend following.
You were hooked. There was no going back. You got proof of concept and you were like, okay, I'm off. I'm going down this path myself.
Yes, correct. Correct. That's essentially what happened.
And you've stayed in Monaco the whole time.
Yeah, I did stay in Monaco the whole time. Well, one thing led to another. I probably, from the business point of view, I probably should have gone to London or to New York or to whatever, Chicago, I don't know. But other things in life happened. I got married, I had children, and now everything got a little bit more complicated. And I thought, okay, well, it doesn't matter where I sit really, which it really doesn't. But on the other hand, it matters a lot that you are not physically too far from your investor base. Let's say from the point of view of managing a portfolio, it really doesn't matter where you are. But from the point of view of marketing your funds, marketing your product, it matters hugely. Sitting in Monaco has been a bit of a liability from that point of view. Life is a lot of things, not just trend following. We are where we are.
I love this quote that you open your book with. There are three avenues of opportunity: events, trends, and conditions. Sun Tzu, The Art of War. Given that I'm in Asia, why don't I let you explain why you would lead with that? That might seem a little philosophical or a little clever to somebody, but I know it's got deep meaning for you.
The main reason why I open with that quote is because I want to impress on readers that trends, this is not a concept that we just invented with modern markets. Trends have been with us since the dawning of civilization. They've always been with us. And so it's not just that we discovered trends in the last 50 years and now people are going to write up a bunch of algorithms and then that whole opportunity is going to get flattened out and go away. This is something that's been with us for the last at least 2,000 years. So Sun Tzu's book is more than 2,000 years old. It's been with us since then. And so it's probably going to be with us for the next 1,000 or 2,000 years, or however long we may continue living on this earth. For as long as human societies are organized in a civilized way and have organized, well-functioning markets, there's going to be price trends in the commodities and securities markets, and with good quality trend following systems, investors, traders, speculators, hedgers will be able to exploit these trends to their advantage and make profits from them and have competitive advantage and generate investment returns. That's the main reason why I opened with a 2,000-year-old quote.
You know, I love that you express some of the negatives to the use of fundamentals in your book. And I love just three little bullet points you say. You know, fundamentals are untimely, partial, and distorted. And the partial part always strikes me because people will send me an email or whatnot, and they never seem to understand that, like, okay, they think they've got all the fundamentals, but there's always another one. There's always another one. So when you end up with this bucket of fundamentals, I just have never understood the logic of how the bucket of fundamentals connects to trend. It's like, okay, you're now a trained economist. You now have this bucket of fundamentals. You're now like a master of economic trivial pursuit. How does that connect to the buying and the selling and the risk management? I've never seen anything outlined that really says anything about that, except when Warren Buffett and Charlie Munger come out, and God bless them, they're successful as you know what. Okay, we've got these two guys that own, I don't know, half of the stock market. We keep holding them out with this unique corporate structure that spends off insurance premiums so they can just buy everything under the sun, and they got more cash than everyone. And that is the example that's meant to keep everybody in line to not think about you, Alex, and your work.
You're correct about that, but if people paid closer attention to my work, they would find out that Warren Buffett and Munger, and also their predecessor, Benjamin Graham, were actually momentum investors, which is another word for trend follower. I really dissected this in my book very thoroughly, where I used Benjamin Graham's intelligence investor, his own words and his own investments to show that his outperformance over the benchmark over his 20-year career was the result of his investment in Geico. Exclusively, if you take out Geico, he underperforms by 2 percentage points per year. So his value picking, whatever it is that he and Newman were doing, actually generated underperformance. And only when you add Geico, you get outperformance. But Geico was, according to their valuation models, overvalued already at the moment when they bought it. And then they kept it for the next 20 years, and it made more than 50% of their return. Benjamin Graham himself writes in Intelligent Investor that Geico contributed well more than 50% of their total returns. So his compound return was about 20% over his career, and over the same time, the S&P 500 returned, I think, about 12%. So you take out that Geico, he falls below 10%.
Let's imagine that we're at the Berkshire shareholder meeting. Perhaps they've brought Ben back from the dead, and they got the three of them up on stage, and you, Alex, are out there in the audience, and you get your hand up. You get to ask this question. What do they say?
Oh, well, I would imagine they would throw out some boilerplate stuff and probably throw me out of the conference. It's not so much what you can say about the present moment, about the current investments. It's what you can observe as a pattern over many, 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 many years.
I meant specifically your example. I liked it, your Geico example. So you bring that up, you show that, okay, that the bulk of his returns come from that. I've not honestly paid too close attention. I paid much more close attention to the Bill Dunns of the world. And look, I respect the hell out of these guys, but has anybody ever got like a legitimate question in, like you just outlined to me, to these players, the Buffett, the Munger? Has anyone ever got a question in about these, the momentum type question?
No, I doubt it. I doubt it. I very much doubt it. And I'm not aware that anybody did. And I don't know why that is.
You might not want to say why, but I think you know why.
No, but I mean, in general, why is it that people embrace this value investing as a concept and reject, well, not that they reject, but they're a bit more circumspect about trend following and momentum. And I think it's just like the innate inclination to kind of look for bargains, to buy things when they're cheap, to sell things when they're overpriced. Trend following inverts that, like trend following, you buy things when you've seen their prices go up and you sell them when you've seen their prices go down. And I think that by contrast, if you pitch value investing, you're kind of appealing to people's intuitive sense of bargain hunting. It seems to rationally make sense, to pick up bargains that you find. And then the fact that it doesn't really work is something that you can only ascertain over long periods of time and if you pay close attention. But if you just buy what's on the tin, the gloss and the facade and the narrative, then it's always going to make sense because it rests on this innate idea of picking up bargains. When you go shopping, you look for a cheaper source of goods. Whereas when you're speculating, you shouldn't do that. You should do exactly the opposite.
Yeah. I mean, I wonder without Buffett and Munger in the last 50 years, if there would be this wholesale media lapdog support of value versus having zero curiosity about trend following, or if the occasional trend follower made it to CNBC, they ask some smarmy questions and imply that it's voodoo or something like that. It is a really interesting conundrum in the sense that you would think that once people understood, especially with some of these performance records that go back decades, that some of these investors out there would be like, wow, that's really amazing. And look, somebody could say, well, okay, Alex just said that there was a 10-year period for many trend following traders that didn't work well. Well, what did equities look like from like the 60s until the early 80s? I mean, you know what I mean? You can find these stretches anywhere, right?
Yeah, correct. It has always been, and it always will be, a sequence of feast and famine. We're not going to get around that. If you look at why CTAs underperformed over the last 10 years, is because they're diversified and many of them trade heavily in commodities, and commodities have traded flat. But that doesn't mean that markets don't move in trend, because if you look at what happened to the treasury prices, if you look at what happened to the equity prices, they've clearly been in a massive trend. So let's say if some CTA was only trading the S&P 500 and the NASDAQ, they would have done phenomenally well. The reason they didn't is because they are also diversified across all these markets that didn't go anywhere for these 10 years. You look at the commodity prices since 2009, they've basically done nothing with the exception of palladium after 2016. And then there was that one moment in 2014, 2015, when the whole commodity complex went down by 50%. But apart from those two events, more or less, we've seen nothing, just like flat drift horizontally. It's hard to make money in that environment. And that's not the failure of the CTAs. That's just simply the environment. Like if you fish in waters where there's no fish and you come up with nothing, doesn't mean that you're a bad fisherman. It just means that there's no fish in the water.
Well, and I have to remind the audience, and I had a trend following guest on recently, and it's interesting with trend following traders that often the scars and the wounds and all the negatives just roll out nonstop. And I have to remind people, like, hold on, there's something positive going on here too. Trend following traders seem to be burdened with this narrative that they have to put all of the negatives, lay them on the table in front of everybody. Eventually we'll get to the positives. You're talking about the commodity markets not trending, but as I said earlier, that seems to have reversed pretty hard and pretty fast.
That is correct. Michael, I'll just get back a second to what you just said. What you just said is exactly right, because this has been my problem in the hedge fund world. And it's exactly that you have to lay out all the negatives to investors because you're selling them risk, actually, right? So you have to kind of disclose, you might lose your money. There's risk. We cannot predict a future performance. Past performance is no guarantee of the future. It's almost like the culture of the industry is like you almost cannot talk about the good stuff. You only talk about the bad stuff. Most investors, even those who would be qualifying as sophisticated investors, they're not all that sophisticated. And the smart money is not all that smart. That's my experience.
Look right now at the teens and the 20-somethings. They've said to hell with smart investing. These folks are playing crypto coin insanity left and right, and they could care less. It really, if you look at the generational divide, the boomers and their 70s and 80s and whatnot, that supposedly think that maybe they're going to get interest income again in their lifetime versus the teens and the 20-somethings that are taking 20% volatility like every 5 minutes. It seems like the trend following audience might be the younger generation. They seem to have turned the risk appetite on its head.
That's correct. And you can see it in the markets, literally tens of millions of them set up in individual retail brokerage accounts.
A lot of them don't have any strategy either.
That's true. They don't have a strategy. And in some jurisdictions, these retail brokers have to disclose on the front page what percentage of their clients lose money. And the numbers are staggering. It's between 71 and 76%. 3 out of 4 of their clients actually lose money. There's actually a great need out there to adopt a sensible strategy that can be applied on the long term with discipline. You have to kind of understand what you're doing to do it well. If you're just drifting around, going on a whim, going on the message boards and trading stuff because you see other people made money on that stuff, it always ends badly. But I think this is where maybe bringing the trend following as a concept and as a strategy to the broader public can actually help them not get killed by these markets that they don't understand.
I still remember how many more people were contacting me in 2002 at the NASDAQ at its minus 77% bottom. So many more people were interested in trend following then. Now, when you've got a situation like right now, there is a lot of people with zero strategy that are talking about how they're making money in either equities or crypto. You and I know what that ultimately means. If one is out there in the market and doesn't really know why they got in or doesn't have a plan to get out, it is not managing the risk, properly sizing their trading versus their account size. You and I know what happens. It's just a matter of when, and you and I cannot predict when.
Yeah, that's absolutely true. And unfortunately, that's how it is. But I think it would be good if if there was a way to help people.
You do a great job of it in your book. I mean, your book is really detailed. I was looking through, and as someone who's written books about trend following, I'm like, ooh, I wish I could have stolen that. I want to steal that, but mine are already written. So I can't steal that idea and can't steal that phrasing. I guess when people hear me say that, they'll realize it's catching my eye too. It's just a different perspective, a different angle, a different way of looking at it. And let me ask you this. How many people from your hometown, the people that you grew up with, how many people from back in Croatia that have any idea about what you do and your type of thinking?
Not very many, Michael. Croatia is a country that lives on tourism and maritime industry and some agriculture and minimal industry. So financial services, investment management, speculation on global markets, very few people actually do that. Croatia has produced analysts like Marko Kolanovic at JP Morgan. JP Morgan has like 4 or 5 Croatians that write their research reports. There's bunches of them, but they've all crafted their professions in London, in New York. People who live back in Croatia, they don't do these things. They don't necessarily understand it. I've resolved to try to popularize the idea and the concept by literally yesterday, I launched a YouTube channel. Books are something that some people read, but I think that more people watch stuff on TV and on YouTube. So maybe this is a way to reach a wider audience. So I'll try to simplify the concepts and try to convey them, because otherwise, all they can do is go to their bankers, and then the bankers tell them, you should be long stocks. And that's where the story ends.
The competitive channel is coming. I've been assembling all the gear and setting aside the space. And to try and do it right, I got to tell you, the podcast is easy. If you saw my gear setup right now, it's nothing. But doing a proper YouTube channel does take a little bit of gear for sure.
Correct. And that's a turnoff, because I'm a person in whose life the perfect has always been the enemy of the good. But I'm trying to grow out of that, So I say okay, I can't make it perfect, but let's go out with something that's good, and then we'll perfect it over time. Maybe it's going to take over time. Waiting to be perfect to launch myself out there, maybe I'll wait forever. Maybe I'll lose interest eventually.
Let me keep you at groupthink, mobs, crowds, manias. It's easy whenever there's a big price run and whatever. It's easy for people to go back to tulip mania and whatnot, the Holland time period and all that kind of stuff. What do you think of when you're sitting around with friends, your peers, and you start to talk about groupthink and mania? I mean, it's almost like being a psychologist to try to analyze people. But the average person that really doesn't yet have your detail, they look at their neighbor. And if their neighbor is doing something, I mean, I can't tell you how many women that I've known in my past, just associates or whatnot, have texted me to tell me they bought Bitcoin. They want me to give them a pat on the back. They don't have any idea why they bought it, but they bought it. What do you think about when you start to look at group behavior? What are some of the first thoughts you have?
Well, the first thing, I think it's perfectly natural. That's what we do. And this is what forms trends. If you enter a market as a rational investor, what you want is to invest in something of value that's going to give you a stream of rents, and that you might want to sell at a higher price than what you paid for, right? And in order to do that, you have to kind of reflect on what other people think and want and do, because that's who's going to pay your rent. That's who you're going to sell your assets to eventually. When you see that people in your environment are piling into real estate and you see real estate prices go up, then you think real estate is the place to invest, because if I buy today, probably in a few years, I'm going to be able to sell it at a higher price. I think that this is perfectly normal. We all do it. Everybody does it. You have to reflect on what the rest of the people around you think and what they're likely to do, because that's what informs your investment decision, not necessarily because, like if you're a value investor, you might say today, like, hey, like houses are really cheap in Afghanistan. But at the same time, you know that houses are going to probably stay cheap in Afghanistan, and it's for a reason. But if in your environment, the house prices are rising, then you're thinking they're going to keep on rising because this is what people invest in. And so I'm going to do it too. And so that's how trend gestates and eventually accelerates. And then as it accelerates, more and more people get excited about it, which accelerates it even more. And that's what happens. It's not about value. It's about what you think other people might think and want to do. In regards to Bitcoin, it was about 2016 when I resolved I wanted to invest some money in Bitcoin. And it was trading at around 400, 500. And I made the decision purely on a trend following analysis. I looked at the chart, I waited. And at some point, maybe it was not 2016, maybe it was 17, whatever. But I saw that the curve was starting to trend up. And then I thought, I don't know what this is. I might lose all my money, but I might double it or make it a 10-bagger. At that time, when I talked to people about Bitcoin, they said, no, don't do it. This is a fad. This is nothing. This is just vaporware. You're going to damage your credibility. You're going to damage your reputation, blah, blah, blah. And so everybody was an expert in why Bitcoin was a stupid idea. Well, when it hit $50,000, I had people call me and say like, dude, maybe we should buy Bitcoin. Look at it go up. And I said like, what? It just went up 100 times in the last 3 years. You want to buy it now? They said like, no, obviously. We wait until it makes a pullback and then we buy. I thought, why not think about silver or gold, things that haven't made a move yet? But this time, everybody's an expert about why gold is a stupid idea and why silver is a stupid idea. And then when silver and gold go up, everybody's going to become an expert about why gold and silver are brilliant ideas and we should go and speculate on that. And that's how it is. Unfortunately, it's probably been that way for the past 2,000 years or more. And it's probably going to be that way forever. It's human nature. I wouldn't even call people credulous. I wouldn't call them naive. It's just the way we are. Your perspective and my perspective is that maybe we pulled back. We tried to analyze this process and maybe thought maybe this can be exploited to our advantage. And so that's the difference between me and everybody else.
I think it's interesting as you talk about the average person, they see what their neighbor does and they want to get on. The part that always strikes me is it seems like the average person that wants to participate in the trend, that's actually a good thing. They seem to not be afraid of getting on board. They don't care where it came from. There's a lot of action here. I'm just going to jump on. They all seem to uniformly jump on with no idea of when they're going to get off. It's not even thought about. That's the part that I sometimes wonder what's going on. Even the average person, how can the average person imagine that something will only go straight up? Because the average person can probably think of times where the thing has come straight down. Even if they don't know what a stop is, just the idea of when are they going to get out?
That's actually hardwired. That's hardwired. We spent 99% of our natural history living in small bands of nomads in a world that is stable. You are hardwired to expect that tomorrow is going to resemble today and yesterday. And so this circuitry, which we still carry, it hasn't changed with the changes in the markets in the last 100 years, also makes us believe that things we saw today and yesterday are also going to be true tomorrow. So if we see certain markets go up, it's practically inevitable that a large segment of the population is just going to assume that this is what's going to be happening to infinity. So there's no sunset on this circuitry. It's just hardwired that we always expect tomorrow to resemble today. For that reason, I think when people see a good thing, they latch onto the good thing. And even though they're rationally aware, if you speak to them, they're rationally aware that it has to end, subconsciously, there's no urgency. There's no urgency to plan the decision when I'm going to jump off. I have to jump off. It doesn't happen. So they wait until circumstances change and until they register this change of circumstances. And then they think like, oh shit, now what?
You make a great point about stability, that if we just imagine, like, I don't know, Stanley Kubrick's 2001, the monkeys out there. I mean, things go that way for a long time. If you look outside your window and whatnot, okay, there's cars, there's streets. I mean, look, the harbor there at Monaco, it doesn't change, right? There's only so much change. So I think people get seduced by the stability that we see around us. But when it comes to markets, to assume stability is there and to not have some sense of probability, it's where it all kind of breaks down.
Yeah, correct. And this is why as many as 90% of all active professional investors underperform over long stretches of time. And this is why 3 out of 4 individual investors lose money when they do this, when they play this game. They play the game because they sense opportunity and they're dissatisfied with what standard asset management products deliver them. But at the same time, then they don't know how to navigate the risks. They assume they're going to be able to do well, but then obviously 75% of them don't do well.
As you said at the top, you talked about bubbles, and I assume you were speaking primarily about equity market bubbles. Without being specific to any one person, because you can't be, what kind of thinking or process could you implore upon people that are perhaps been long equities since the Big Short days of 2008, 2009. They've made a lot of money. And why would I get out? Why would I listen to Alex or Mike and even have any caution? I mean, stocks went down, 50% S&P and, around the dot-com bubble, another 50% around 2008. Everything bounces right back. You can tell me all these things about the Fed and all this other kind of stuff. But the reality is you're telling me to be thinking about prices, Mike and Alex, and right now, U.S. stocks look really good. Look, if we get to a situation in the next handful of years, and if U.S. stocks took a 50% hit with the baby boomer generation in retirement and no interest income, a lot of these pensions in America all depending on equities to the moon as the way they're going to fund themselves, there could be a real nasty scenario here if we saw another 2002 or 08 to 09 equity market implosion.
I would ask them to name me one bubble in history of mankind that didn't implode. There isn't one. There isn't a permanently high plateau of stock prices ever anywhere. It always implodes. I would also tell them that when bubbles implode, you usually have a bear market that ensued. I don't mean bear market like 50% 2-year thing that we've gotten used to since the 1980s. I mean a real bear market. Like after the stocks crashed in 1929, it took almost 30 years for the Dow Jones to recover its losses. The stock valuation declined by 86% from peak to trough. And when the Japanese imploded in 1989, it went into a 20-year bear market and the Nikkei lost 82%. And it still hasn't recovered more than 30 years later. I would tell them that this is going to happen. We don't know when, but you need to make allowance that it will happen and that this idea of stocks for the long run, you need to make it for a really, really long run. And you may never recover your investment in real terms. In nominal terms, maybe after 30 years, but in real terms, not. And then I'll tell you another staggering thing. One of the examples where the stock markets went vertical in a bubble like we have today was the Weimar Republic in Germany in 1920s. And so when that bubble imploded, at the end, we're talking December 1922, you could have purchased the entire interest in the Mercedes-Benz company for the equivalent price of 327 of their cars. And I'm pretty sure that they must have had 327 cars in their dealerships. So basically, you could have had the company for nothing if you preserved your purchasing power. At the time, if you had US dollars, which were still backed by gold, you could purchase a villa at the outskirts of Berlin for $100. So I would tell them, A, the bubble is going to implode. There's no question about that. It's a question of when. And B, if you take care to preserve your purchasing power, there's going to be staggering opportunities at the other end of that event. Just be rational and try to, because in the end, only the trend followers are probably going to trade the bubble implosion successfully.
That's what the historical record shows. I mean, I guess Spitznagel and Taleb, those guys doing their option tail strategies, they're kind of like trend followers by a different name. But you're right. There's only a few players and styles out there, trend following being the leader, that when you have these implosions, whether it's Barings or the big short time period or the dot-com bubble, the track record's clear. Some trend following traders, they don't want to talk about this term that's come out in the last decade, crisis alpha and stuff like that. Sometimes folks that are associated with the market, they get all caught up on marketing phrases. But to me, I just look at it like you're saying, which is like, okay, if we look at the big events of the last 30 or 40, 50 years, however long, we can see that during these time periods when the unexpected happens, trend following is the strategy that has data to show that it worked.
Correct. Exactly.
Alex, very cool stuff. Nice to meet you. Nice to talk with you.
Likewise, Michael. Pleasure. Now I have the voice to the author of one of the first books on trend following that I ever read. So that's brilliant.
Have you ever listened to any of my podcast at all?
I've listened to the one where you mentioned my name, but I didn't even know that you had podcasts. I didn't pay attention.
Gotcha.
And because I'm a convert already, I don't need to be sold trend following. I pay more attention to the other side, what they think, what they say, how they analyze market, because to be very honest, I want to kind of bring the other perspective to them. So I want to understand where they are in their thinking. So I actually do a lot of fundamentals analysis.
It's funny that you mentioned about not wanting to hear from trend following traders. And I've had all the names that you know on this show, but I kind of had the same problem because the first year I started this podcast, 2012, 2013, I was only interviewing trend following mindsets. And at some stage of the game, I'm not going to say I got bored, but you kind of tap out a little bit. You're like, okay, I need some diversity here. Right. When I got Daniel Kahneman to come on, then I just went, I'll talk to anybody about any subject. I mean, trend following is still the core, but I would say in the last 5 or 6 years, it probably only accounts for maybe 10 to 15% of my episodes. Most of it is not that.
Oh, okay. Cool.
Recently, I've had a couple trend following episodes. Yours is going to be included. Your book is great. I think people should check it out. Trend Following Bible. Easily found everywhere, I assume?
It's a self-published book, so it's on Amazon. It's not in libraries. It's not in bookstores. If anybody of your listeners has issues ordering books from Amazon, they can email me. I'm happy to send them a PDF free of charge. It's fine.
And by the way, I should tell people, this is a serious, detailed work. I published a bunch of books and a bunch of different publishers, and sometimes I want to pull my hair out working with publishers, and I've imagined doing the self-published route. And sometimes I will see some self-published works that I want to say to myself, well, you probably should not have published that. I can safely say that that's not the case with your work. And I would tend to think that at some stage of the game, some of these large publishers, if you so desired, I would think they would put your book into their slipstream. You might not want that though, but I think there's no doubt that if you wanted to find a big publisher, I think they would say, yes, we will take you, Alex. I don't think there's any doubt about that.
I did try that at the beginning. And then my initial contacts with prospective publishers cooled me off to the idea because, I'm not an author, I'm not a journalist, I'm not a writer, I'm a money manager, and this thing is on the side. And now to make dealing with these people as a part of my life at that time, I didn't want to do that. So I thought, I'll just do the easy thing. I'll publish the thing. I'll put it on Amazon and I'm done with that. It was a thing on my to-do list. I wanted to cross it out. My initial contacts with publishers were not encouraging. It's almost like they need you to be a celebrity, and it doesn't matter if you've written the best book ever written. They won't even read it. They literally judge the book by its covers.
I'm lucky in the sense that when I put my first one out in 2004, I was in the same boat as you, a no name in the publishing world, and they gave me like $15,000 to write Trend Following.
Oh, hey, that's something.
Yeah, it's made a little bit more than, but they didn't know what it was, and they didn't know anything about me or anything like that. One guy took a gamble, but when you phrase the publishing world as these people, I understand why you call them these people, and we shall just leave it at that. So these people don't come yell at me. I'm in a position now where I don't have to worry about it, but I can imagine as a first-time author walking away with the phrase, these people. I get it. The book, Trend Following Bible. Alex, where can people find you if they want to make it to you, or do you want them to find you?
I have a website called iSystem Trend Following, isystem-tf.com. My book is on Amazon, Alex Krainer's Trend Following Bible. And I just started a YouTube channel called Markets, Trends, and Profits. And we'll see what that's going to amount to. I've been moving from money management to kind of activism because I see that there's going to be a bumpy ride in the markets. And I'm afraid that most people are going to end up hurt. Some part of me wants that to not happen because I know many of these people. Anyway, we'll see. So that's where they can find me. I appreciate being in this podcast with you, Michael. Thank you. And warm greetings from Monaco to all your listeners.
Alex, thank you. Take care. Hopefully we'll catch up in Monaco someday once all this COVID stuff stops.
Yeah, with great pleasure. Take care, Michael.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, Trend Following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.